Hello, I'm Boyd Davis, the organizer of this event. This is the third in a series of value chain events, this time on gold. And its purpose is to give investors an understanding of the entire supply chain of a particular commodity. It's brought to you by the Metallurgical Society of the Canadian Institute of Mining, Metallurgy, and Petroleum. And I'd like to thank our sponsors, the World Gold Council and CI Private Wealth. And I'd like to start this off by just having a quick view of why gold is gold. Why is it the currency of choice? There are some features of a currency that need to be there for it to work properly. It has to be a controlled or a rare supply. It has to be a durable material. It has to be easily carried. And as a bonus, it has to be significant infrastructure to attain, something on the level of a government getting organized to obtain it. And this could be not metals. This could be things like shells or tea or import goods that are not native to a particular region. But soon, within the 7th or 6th century, metals started to be used as currency. If we focus on metals, we look at what are the elemental properties that they have. They have to be stable. They can't burn. They can't be toxic. They have to be somewhat malleable to be able to be formed into coins. They have to be relatively rare, but not too rare, and they need to be readily purified. So that only leaves a few metals left, 5 to be specific: platinum, palladium, rhodium, silver, and gold. Silver is too abundant, even though it's only 8 ppm on average in the Earth's crust. It's too abundant, still used as a currency, but as a minor currency, an important one, but a minor currency. Rhodium is too rare, and platinum and palladium's melting points are too high. So that left people with gold, where it was abundant but not too abundant in the Earth's crust, and it had a melting point that was within reach of ancient techniques to melt metals. So gold became the standard for currency globally. And just as it's a bit of a different metal because of that, the investing in gold is a little bit different as well. And Marianne will take you on that journey following this. Thank you.
Hello, my name is Marianne Crichton, and I work for Hatch, the Hatch Advisory Group of the Management Consulting Group. I've organized the speakers for day one of the Gold Value Chain Seminar. What makes investing in gold so different from other metals? You will hear that gold has little industrial value and is used mainly in jewelry and as a store of value or as an anchor for the money supply. We all know about gold jewelry and gold coins and gold bars, but why gold and why not other precious metals such as platinum and palladium? There are a number of factors that drive the price of gold, and that gold does not necessarily follow the typical supply-demand economics, and that makes forecasting the price of gold particularly more challenging than other commodities. Today, there are a range of speakers that will address the different ways to invest in gold. You'll hear about gold stocks, gold funds, gold ETFs, gold physical product and how to store it, and flow through shares. And the Canadian junior exploration mining sector is very active and vibrant, and there are opportunities to actually invest in early stage companies. There are a number of unique aspects of owning physical gold. For instance, using blockchain to certify ownership of reserves being left in the ground unmined. This would minimize ESG impacts and have utility in anchoring the money supply. You will also hear about energy considerations and gold carbon footprints. There's an interesting line of speakers and two panel discussions, one at 9 and one at 10:30 to ask plenty of questions. Please enjoy the day. Thank you.
Hi, My name's John Reed. I'm the Chief Market Strategist of the World Gold Council. I'm going to talk through the supply and demand dynamics of the gold market. Just briefly, the World Gold Council is a membership-owned organization. Our members are the largest gold mining companies around the world. We're responsible for developing the gold market, for improving knowledge and trust about gold, and some of the key areas that we've worked on over the last 35 years are described on the right-hand side, including launching gold-backed ETFs in the United States, developing the Chinese gold market in conjunction with the government. I'm not going to run through those in detail. I would encourage you to go to our website, gold.org, to learn more about the organization, the data, the tools, and the research that we have there. So I'm going to talk about supply and demand fundamentals. And as I do so, it perhaps helps to have what I describe as the shape and size of the gold market in your mind. First thing I'd say about gold is it's very different from other commodities. When you look at base metals, or whether you look at energy or agricultural products, you look at stocks in terms of months of production or months of consumption. Same thing, really. In the case of gold, we don't have months of consumption in stocks. We have decades. So the total size of the gold market is about 5,000 tons a year of production and recycling, as I'll show later. Total above ground stocks now will stand at something slightly more than 210,000 tons. So that's decades worth of consumption there. Now, the thing about gold is you mine it, you refine it, you turn it into other products, and it never really goes away. Jewelry demand is out there, and there's a lot of recycling of jewelry that comes back to the market each year. Central banks currently buying gold, used to sell gold. That gold could come back to the market if needed. And similarly, the coins, the large bars, the small bars, the big bars, that back the ETFs, that's all available at some price to come back to the market. It's only what has gone into industrial demand, probably something between 5 and 7% of demand for gold since antiquity has gone into industrial demand. Some of that gets recycled. Some of it, particularly that's contained in electronics, does get thrown away each year. But the total amount of gold mined, if you were to put it in one spot, would represent a cube of 22 meters in size. So gold is a global market. If you look at the demand from around the world, you can see that pretty much all of the regions contribute to one degree or another. But one of the things that has changed over the past few decades is the dominance of emerging markets for gold demand. China, India, together more than 50% of consumer demand for gold. Middle East and Southeast Asia also important. So Canada, United States, Europe, only constituting something like 20% of demand for gold. And indeed, emerging markets now 73%, developed markets only 27% of global gold demand. A big change from when we as an organization started, when developed markets dominated demand for gold by about 2/3. And the demand for gold has changed also over that period. Used to be very much dominated by jewelry. That's now declined to only about 37%. Technology stands about 7%. Investment, 38%. And central banks that were selling gold when we started as an organization are now responsible for buying. In the case of these last two slides, that's been based off 10-year averages. So trying to strip out some of the ups and downs we see on a normal year. If you look, however, and the slides to come, you'll see there's been some big changes, particularly regarding central banks in the last 2 years. So let's talk about gold supply. We count two contributors really to gold supply. Obviously, mine production, which is the biggest, and then also the recycling of jewelry and old technology. And this is very much dominated by recycling. just looking at it over the last 40 years or so, you can see how we've gone from about a 2,000 ton market to the current levels of just below 5,000 tons. So the supply of gold to the market's increased. Looking at mine production on its own, I've taken away recycling to make this a bit clearer, you can see how it has grown over time. It has periods of relatively rapid growth and then periods of almost stagnation. This is very much related to what the gold price was doing in the past. So if the gold price goes up now, you don't immediately get more production. But as you can see, following the global financial crisis, gold production did increase relatively sharply from, say, 2010 to 2018. And that's a reflection of the fact that the gold price started to go up in about 2001. From 2018 onwards, though, we've kind of plateaued in gold. Now, we don't have the full year for 2023 yet, obviously, but what we can see looking at the first 3 quarters year to date is that mine production looks like it's going to set an all-time high this year, up a couple of % on what we saw last year, and breaching the previous all-time high in 2018. But I'd characterize this performance over the last 5 years as more like plateauing. We're not seeing a tremendous amount of new mines coming into production. It's going to be difficult to grow rapidly from here, although there could be a bit of growth for the next couple of years. Recycling of jewelry and technology has grown steadily over the period. There's been some surges that have taken place, though, particularly around the global financial crisis. It's interesting to me that we haven't seen a surge in recycling of old jewelry this time, even though the gold price has gone on to hit higher highs. That's probably due to the fact that unemployment hasn't picked up and consumers are not distressed. I guess the other thing is as well, it's only been 10 or 12 years since the last surge in recycling. So perhaps a lot of the old jewelry that people did have that were looking to recycle has been indeed recycled already. So recycling changes more year on year than mine production does, and it can be a very volatile component of supply. Not many people think too much about it. So let's turn to demand. And I've put them all together here, same time frame, back from 1980, and it does look a bit of a mess. So I'm going to take this apart and have a look at the individual components. But you can get an idea that, well, demand has pretty much matched supply, which is what you would expect to happen. When we do our supply-demand balances, there is always a residual, which is made up of demand we can't track, particularly over-the-counter investment demand, but also the errors in estimation for all of the components of supply and demand. But in general, supply matches demand and the price clears. So let's talk about jewelry demand. It used to be the most important component of the market. But don't forget, the gold price in US dollar terms hit a low of about $252 an ounce back in both 1999 and then 2001. So gold was more affordable then. The increase in the price that has taken it up to about $2,000 an ounce at the time of writing has had an impact on jewelry demand, as you can see. So it stopped growing at around about the time the price bottomed and has then been declining, maybe signs of stability over the last 10 years or so. Very healthy for the gold market, the fact that people are still prepared to buy good amounts of gold jewelry with a price at $2,000 an ounce. But it is fair to say that we're not seeing rapid growth in this sector. But what we can see here is the growth that has come through from investment demand. Now, when the World Gold Council started in 1987, investment demand was a much smaller component of the market, jewelry demand much more. But in the run-up to the global financial crisis, when investors were wanting exposure to commodities, and then, of course, the global financial crisis itself, we saw a big pickup in investment demand. That investment demand took place in a number of different segments. Exchange-traded funds get a lot of attention here, but the bar and coin market is an important component of gold demand too. In fact, responsible for much more, on average, than ETF inflows or outflows. Since the global financial crisis, investment demand has remained an important component of gold. It does slow down sometimes, like it did in the late 2010s, before we saw the surge around the coronavirus pandemic, but seems to be maintaining at a decently high level at the moment. Another really big change that's taken place within the gold market has been the actions of central banks. Central banks sold gold collectively or in total for 21 years in a row, and then stopped at the time of the global financial crisis. This selling was done by legacy holders of gold, so the developed market countries that in 1971 had ended up with large amounts of gold in their international reserves. They were reducing those holdings. But the global financial crisis stopped that selling. And we don't see any material selling now from developed market central banks. What we've seen since the global financial crisis has been buying every year predominantly by emerging market central banks. And that's averaged about 470 tons or so between 2010 and 2021. But you'll see the last bar there representing last year, 2022, around 1,100 tons of purchases, a much faster rate of accumulation by central banks. And that's continued into 2023. For the first 3 quarters of the year, we estimate 800 tons of central bank purchases were made. So we're probably going to come close to the record level of purchases we saw in 2022, perhaps setting a new high this year. Technology demand is something I find very interesting. It's not a big component of gold demand. You may remember from a chart I showed earlier, about 7% of net demand. And it has declined a bit as the gold price has moved higher since the early 2000s. And the reason for that is, even though gold is excellent in many applications, particularly electronics, as the price has gone up, clever engineers have reduced the amount of gold that they're using. But they can't get rid of it entirely. You couldn't run the modern 21st century economy without gold in technology. Everything would be bigger, bulkier, would break more often. And certainly the miniaturization that we've seen just wouldn't be able to take place. So it's a really important component of gold demand, even though in absolute tonnage terms, it's not huge. So what drives supply and demand? We've done a lot of work looking at quantitative modeling of the gold market, both on the supply side and the demand side. We have this model available to use on our website, where you can put in macroeconomic factors. In other words, what's global GDP growing at, what's inflation running at, etc. And that will change the forecasts for jewelry demand, technology demand, and all the other aspects as well. This allows us to model what the gold price may do under different macroeconomic scenarios. So we don't forecast the price of gold ourselves. That's not something we're able to do in terms of our organizational structure. But we have built a number of tools that demonstrate how supply and demand are likely to change on the basis of macroeconomic fundamentals, and what that might mean for returns in gold going forward. Again, I'd encourage you to go to our website, goldhub.com, to have a look at some of the tools we have there. You may find them very useful. The Quorum, and I apologize for the spelling mistake, I hated the branding of this, but the Quorum valuation tool here does exactly that. It allows you to stick in your different estimations of macroeconomic parameters and see what will happen with a forecast for the different components of supply and demand. Again, goldhub.com contains all of the data behind this. We produce a quarterly report called Gold Demand Trends that analyzes demand and a little bit about supply as well in the gold market, that I thoroughly encourage you to have a look at. If you're interested in supply and demand fundamentals for gold, it goes through that in a lot of detail. And there's presentations and animations and videos that come out, which you can get from our website. So thank you very much for your time.
Good morning, and thank you for joining us today for the Value Chain Series Gold event. I'm Chantel Skeven from Capitolite Research, and just to give you a little bit of background about our company, we publish weekly and monthly subscription-based research that focuses on gold, silver, copper, nickel, lithium, and select rare earths, technical analysis, and information, economic and market data on the U.S. and Canadian economies. Our flagship publication is our weekly gold monitor, which I work with Dr. Martin Manbild, who started the publication more than 40 years ago. So just to get started, there's always the disclosures. We just want to say today's information is for educational purposes. We're not giving any investment advice, and we hope that you find it useful. I want to start off. My topic today is the opportunities and the ways to invest in gold, but I just wanted to start off with 2 slides on recent developments that discuss, it's a really exciting time in the gold market right now with gold at a new all-time high. And we have lots of reasons to be bullish on the gold price and our outlook. So when we produce our forecast, we break down factors to bullish and bearish factors. And I wanted to share some of our long-term bullish factors as the U.S. dollar seriously overvalued. We think it's going to continue rolling over. Record debt levels are going to keep central bank policy very easy and interest rates lower than they otherwise would be. Some of our medium-term factors, so we're looking medium-term is about 2 to 5 years, is the recovery of gold demand in India and China. We think central banks will continue to buy gold as they diversify their holdings. And then really short-term factors over the next 2 years, the Federal Reserve, along with other central banks, are starting to change policy, going easier, which means lower interest rates, which is generally positive for gold, and then also the geopolitical crises. So to jump into our topic for today is how can investors take advantage and invest in gold in exposure in their portfolio. So I broke it down really into just 3 topics. We have a little bit of limited time today, so as this is a high-level overview, you'll be getting some other great information from presenters on the supply-demand dynamics, on how gold does add to portfolio diversification, and then also on how to actually pick companies within the gold market, all coming up in today's presentations. But to invest in gold, there's really, the 3 ways that we broke down to was physical gold. You can invest really coins, bars, jewelry. This would also include ETFs, gold producing companies. So your mining companies, the ones that are pulling the gold out of the ground. And 2 ways to go about that is individual companies or mutual funds. And then there's other types of companies, which we're going to discuss today, royalty and streaming companies as a way to invest. Starting with gold coins and bars, these are, generally gold coin buyers. You can buy them from different places online or through, like example, the U.S. Mint, the Royal Canadian Mint. A lot of investors sometimes will keep them at home. They will put them in a safe deposit box, put them in their home safe. They do make great gifts. Some people give them to their grandkids, for example, as gifts. Going to bars, they come in different sizes, which makes it easy to buy different denominations. A lot of times investors will hold bars within a storage vault of the company they're buying it from. And again, there's lots of different companies that offer these services. The disadvantages to gold coins and bars is they're not in an investor's portfolio per se. They're not a financial asset that the advisor has in their portfolio. And that there's a premium over gold price to buy these bars and coins. And then you're also paying storage fees on top of it if you do have them stored with a dealer. So in another way to invest in gold bullion then is ETFs. ETFs became very popular in 2004 when the SPDR ETF was the largest ETF, was really took off. It is one of the most popular ways for investors to invest in gold bullion. It allows you an investor to invest in smaller amounts. You don't have to buy a 1 ounce coin or, so much you can invest. And it's usually broken up to about 1/10 of the gold price is the way that it does it. They have, it does help to diversify a portfolio to have gold. And some of the things to consider when looking at an ETF is the cost. Not all ETFs have the same cost structure, the liquidity. Of course, there's larger and smaller ETFs, the tracking error. So ETFs really follow the gold price, and to look for one that follows it more closely. Some of them, because of liquidity or other reasons, won't follow the gold price as well as others. You can also invest in what they call physical or synthetic ETFs, which physical ETFs follows the actual gold spot price. The synthetic is it invests or follows gold derivatives or futures or options, are made up a little bit different. So you would want to do the research on that before you invested in it. And then provide a reputation, just to make sure that it is a good provider, that it's going to be a solid investment in that regard. So go into ETFs. And then, so the next thing that we look at really is gold mining companies. So gold mining companies are, the ones that are pulling the gold out of the ground. They're involved in the exploration, the extraction, and the processing of gold. And their shares can be bought on major exchanges. So you do have different size of mining companies. So some of the biggest ones, Newmont is one of the largest or the largest in the world, all the way down to very small exploration companies that are usually listed on a junior exchange, like the TSX Venture Exchange, or the CSE in Canada. So that can very much differ in liquidity and also in just the maturity of the gold company. So when you want to when you're investing in the mining company, it's not the same as physical gold. So there's a lot of other factors to take into account. And they can be, not only are they influenced by the price of gold, but they're also influenced by the management team, by the production costs, the geopolitical risk. Where is the mine located at? How diversified are the mines? Do they have mines in different countries? Is it just one? How much are they producing? All of those kind of factors really lead into the valuation of a mining company. The other thing in a mining company is you can invest in an individual mining company. So you can ask your advisor, or advisors can look at, individual companies, choosing the best one, which I know there's some talks on that. How do you choose the mining company that's right for you? Or you can invest in a mutual fund, which is an active managed fund. So they do the work of finding the companies that fit their criteria. There's many precious metal mutual funds that focus on gold and sometimes silver. And then there's also gold company ETFs, like the index ETF. So you have an index like the XAU or the TSX Golds, which will have then an ETF that follows that and you can invest in. So just a note on, how do gold companies perform relative to gold? And we put these charts together to really talk about, how gold companies have done relative to gold. And as you can see, going up from 1990 to about 2009, really gold equities had a significant, what we call significant multiple compared to gold bullion. So the two charts here, the top one is the TSX gold equities divided by gold bullion. And the bottom chart is the XAU index, which is the Philadelphia Gold and Silver Company index divided by gold bullion. And by doing this, we can see, from 1990 into 2009, shareholders were really rewarded for ever increasing asset growth. It's really how much ounces was the metric, how many ounces are coming out of the ground. This is also a time when you saw gold companies really growing. They were expanding at the time and really trying to get more and more ounces out of the ground. And then, after the Great Recession was kind of the breaking point, or the change in this trend. And then from 2010 on, you can see that, the ounces wasn't as important, and it really moved to focus on other metrics for the companies: cash flow, capital allocation, shareholder yield. And the gold companies did not keep their share value, didn't keep up with the gold bullion price, so they went down in comparison. But we can really see then from 2016 to now, that trend has leveled off. So 2016 is when we put the end of 2015, beginning of 2016 is when we really put this current bull market starting again. And we can really see that gold companies have now, they're kind of keeping pace with gold. That trend has flattened out. We do think that, gold companies can be more volatile than gold. But as this bull market in gold continues, we do think there's a lot of upside potential in the gold companies. The last thing I want to talk about and discuss today is really royalty and streaming companies. So they're fairly new. I mean, Franco-Nevada's been, is the largest, is the most well known, but they are becoming very popular. So a gold royalty company is really they're an investment vehicle in the mining industry. They draw revenue from a mine after it's permitted. They don't own the mine, but they have an agreement to get a royalty off the mine or off of the production of it. And one of the advantages to the way some of these are set up is that they can keep getting the value even if the gold price falls. So a lot of times a company or like your ETFs, as the gold price goes down, of course the ETF goes down. Same with companies, they do tend to follow the gold price most of the time. So royalty companies are passive investors in the assets, and they don't have the management teams, and they don't have people on the management team. They're really the passive investor. The difference between royalty companies and streaming is streaming companies usually provide the capital up front, and they do that in exchange for the right to purchase a percentage of the production at a discounted price in the future. So some of the most well-known royalty companies are Franco-Nevada, Wheaton Precious Metals, Osisko, Royal Gold, and Sandstorm. And, among these companies, probably, Franco-Nevada has been around, a long time. But, depending on what, an investor is looking for, some of them really focus like Wheaton Precious Metals really has 90% of its royalties and stream in the Americas. So that's kind of a geographical consideration. Some of the companies have, Franco-Nevada has over 200 different companies that it's invested in. So it's got a lot more diversity across different companies. Same with Sandstorm. It has a portfolio of about 200 royalties. So you're getting a large diversity. Those are, just to sum up, really, those are, different ways to invest in gold. And I realized it was a very high level, informational presentation on just different ways to think about investing in gold, whether it's gold bullion, if you want to have your coins at home, or, store the gold bars. Some investors feel much more comfortable and confident having that physical gold and coins and bars. Some investors, if you want to invest in companies, really looking for the one that fits you. Of course, the exploration company that's just starting out is going to be a lot more risky than some of the major companies. And then you can also look at different ways within the royalty and streaming companies that are becoming more popular. So I hope you have a great day and enjoy the rest of the presentations. Thank you.
Hi, thank you for joining me. I'm John Reed. I'm the Chief Market Strategist at the World Gold Council, and I'm going to talk about the case for gold as a strategic asset. This is a presentation that we give many times during the year to investors, mostly institutional investors, about why gold should be in a portfolio all the time. As a brief introduction, the World Gold Council is a member-owned organization, a non-for-profit, and we're designed to promote gold, increase trust, understanding. We've played lots of roles in the development of gold markets around the world over the last 35 years. And I'd encourage you to go to our website, gold.org, to learn more. But let's talk about gold as a strategic asset. It's a unique asset class and very different to other commodities. Often people think because they have an exposure to maybe commodities via an index product or gold mining equities that they have exposure to gold. But gold's very different from a broader commodity index, and it gives you different characteristics from investing in a gold equity. The four key characteristics that gold has possessed over the years is that of returns, diversification, liquidity, and moderate volatility. Adding gold to a portfolio has increased the risk-adjusted returns of those portfolios, reduced drawdowns, and helped protect against shocks. And this works in every market we've examined and over almost all historic periods examined. So let's turn to those characteristics. The first is that of returns. If you look at the performance of gold over the long term, since the link was broken with the US dollar back in 1971 at the end of the Bretton Woods Agreement, or over the last 20 years, or over the last 5 years, gold has produced returns in line with or better than most other asset classes. Only over the last 10 years has gold underperformed, particularly underperforming equities. But then again, the previous all-time high in gold was around the global financial crisis, 2011, 2012. So that's why the 10-year performance doesn't look so good. But the message that we want to give people from here is investors think that gold does well during times of crises, perhaps in anticipation of inflation, and that's true. But that's not the only time that it performs well. It's been a contributor to portfolio returns all the time. Even if it hadn't delivered those returns, the diversification properties of gold would have made it worth holding. So in general, gold isn't correlated to equities. But you can go further than that as well. You can look at what happens when equities are performing strongly. Here, the top bars represent when the S&P 500 is up by more than 2 standard deviations. Then gold's got a welcome positive correlation to equities. But look what happens when when equities are falling fast, down by more than 2 standard deviations in a week. Then gold's correlation turns negative, and that's really useful because you're negatively correlated to an asset that's declining. Gold is a liquid market, so $150 billion roughly turns over every day. That's more than the other asset classes listed there, with the exception of the constituents of the S&P 500. Obviously, the bond market in the US is bigger, even if the T-bill market is actually smaller than gold's turnover. I get annoyed when I read in the papers or listen to financial journalists talking about gold being a risky asset. Yes, it is volatile. It's more volatile than bonds, but then again, so is everything else. But its volatility is very much in line with other asset classes like world equities or indeed commodity indices, and less than individual other commodities like crude oil or nat gas, and some of the other assets mentioned there on this screen. So combining those key characteristics together, we've taken a hypothetical portfolio returns over the last 20 years. It's a US dollar-based portfolio with 50% in equities, 10% in alternates, and 40% in fixed income. You can see the average portfolio risk-adjusted return on the left-hand side of the right-hand graph. We then looked at the impact of adding gold and proportionally reducing everything else to that portfolio over the last 20 years. And you can see that adding 2.5%, 5%, etc., up to 10%, you've increased the risk-adjusted return of that portfolio. So this is exactly what investors are looking for when they're looking for diversification. So having made the argument that every portfolio would have benefited from having gold in it, the question then comes to, well, how much gold? And the answer, like many things in life, depends. It mostly depends on the amount of risk that is in a portfolio. The higher the proportion of equity risk, in other words, the greater the equity weighting, or weighting in things that have similar risk characteristics to equities, then the higher the target allocation. And we've come across portfolios over the last 20 years that have a lot of equity risk and would have benefited from having maybe 10, 12% of their assets or their allocation in gold. If you get a fixed income heavy portfolio, that can dip down to 4 or 5%. And it also depends, of course, when you're looking historically, which country you're looking at, what's the asset mix that they're investing in, and the currency that it's domiciled. The thing to bear in mind, though, is the more risk you have, and that includes things like alternative assets, commodities, particularly crypto, because of its very high volatility. So the more risk you have in a portfolio, the higher the target weighting for gold. As a generalization, and when I'm speaking to people in a normal audience without a specific knowledge of what their allocations in their portfolio is, then around 4 to 8% is the normal target range for an allocation to gold. This is a very short extract of the information that we have available on investing in gold and gold as part of a portfolio. I would direct you to a dedicated site within gold.org called Gold Hub, goldhub.com, and also gets it as well. There's data, research, specifically tools that will help you see the impact of having had gold in your portfolio, together with all the other work highlighted on the World Gold Council's website. So thank you very much for a very short run through why gold is a strategic asset. Thank you very much.
Okay, welcome everybody. And the topic of this discussion this morning or this afternoon is evaluating and investing in gold stocks. And my name is Kerry Smith. I'm a mining analyst with Haywood Securities. There are some disclaimers here. Haywood, the company I work for, is a Canadian-based brokerage or independent dealer. And there are opinions and other items expressed in this document and in this presentation that you need to be aware of. So I would suggest that you read the disclaimer. And I'm a senior mining analyst with Haywood. I worked as a mining engineer for 10 years prior to getting into the investment business, and I've been doing this role since 1992. So I've been around for some time. So I kind of wanted to start out with a little bit of a discussion just on this cycle. And the last cycle. So you can see on this chart here, gold has outperformed the S&P 500 since 2000. 2000 was the start of the last bull market in gold. It ran from 2000 to roughly 2011. As you can see on the screen, gold went from, call it 300 an ounce to 1900 an ounce. And then we've had a pretty long consolidation here since 2011. And I think we're getting back close to another bull market here, but it's been a long haul here. And, just as an aside, investing in gold shares can be pretty volatile. Valuations can be depressed for long periods of time. And, what we've had in this last cycle, this last 23-year cycle I'm showing on the screen, is the S&P 500 has done extremely well, really with the exception of the great financial crash in 2008 and the COVID issue in 2020. But other than that, it's really been a one-way trip here to the upper right of the graph. So, gold and gold shares, I think, can provide some counter-cyclical performance for a portfolio. And I do think that a small portion of any portfolio should have some exposure to gold. So as this slide shows, gold has outperformed the overall market. As I said, it's up 591% since 2000. The S&P is up in the same period of time 212%, so it has significantly outperformed. But from the end of the last bull market in gold, which, as I said, ended in 2011, gold price is up only 42% from there till now, and the S&P is up about 250%. So the S&P has significantly outperformed this last cycle. And the other thing to note from this chart here is this year, gold has pushed through US $2,000 an ounce 4 times in 2023, following the long consolidation that we had from 2014 to 2019. And a sustained break above 2,100 an ounce, I think, is needed to really get the next bull market in gold started. And as I said, the volatility has been pretty high. The overall market's been much more predictable, in a pretty good uptrend since 2010. And that's really one of the reasons that there hasn't been a lot of invested capital in the gold space, because of that outperformance of the general market. So as I say, gold has outperformed. Why haven't the gold stocks? And this shows that the GDX has significantly underperformed the S&P since 2006. It's actually down 11%. S&P is up 250% roughly. And the shares have underperformed for a number of reasons. Gold stocks are a small percentage of the overall market, and essentially there is no weighting in the S&P 500 for gold stocks, so there's really no reason for any portfolio manager that is benchmarking himself against this index or any other similar index to really own a gold stock unless there's a reason for outperformance, and that hasn't really happened. So that's been one of the impediments. The sector has been historically a pretty poor allocator of capital as well, and generally the sector doesn't pay a dividend or pays a very small dividend. But in the last 3 to 4 years, the sector has been delivering higher dividends. The dividend yield for a lot of the senior producers is now over 3%, and you've got a better allocation of capital. I think people are being more critical of investment decisions by mining companies, investors particularly, and that's helped. And I think that there is change afoot here, and I think that will help with the valuations. But as I say, because the gold equities are a tiny subset of the overall market. I mean, the U.S. equity markets are around 46 trillion U.S. The gold stocks are only about 250 billion, so they're pretty small. And when the overall market has been doing extremely well, as it has been, there's really been no reason for investors to be in this space. By comparison, I should mention that the above ground inventory of gold in the world is worth around 12 trillion today. So it's a pretty big number, and it's a pretty liquid market trading in gold bullion itself, as compared to the shares. The larger senior companies are pretty liquid, but a lot of the smaller explorers and developers are not very liquid unless you get a really hot market. So this chart just shows the gold and the silver prices. Gold in the yellow and silver in the silver color, effectively. And silver has been a pretty good proxy for silver. It is for gold. It is an industrial metal. But silver price is highly correlated to gold prices. Although I would say on the silver shares, it is a much smaller universe. Most of the silver production comes as byproduct production from base metals mines. And primary silver producers are not very common. There's not very many primary silver assets. So I think gold really is the way to play the precious metal space. Silver, as I say, is a much smaller sector, not as many companies. The shares aren't as liquid, and the largest silver producer today is Fresnillo, produces about 50 million ounces of silver a year, which is a big number, but as gold equivalent, it's only about 600,000 ounces of gold annually. And, Newmont is the largest gold producer. It produces around, it's north of 6 million ounces. So if you're looking for scale, you really have to look at the gold stocks. This chart just shows the GDX has underperformed the gold price this cycle. And, that's a function, as I said, of, capital allocation. There's not been a lot of investors in the space because they've been able to make money in the overall general market. But I think that, historically, the delta on the GDX versus the gold price was typically about 1 to 3. So for every 1% move in the gold price in a bull market, but like we had from 2000 to 2010 or 2011, the equities would move about 3%. So there is good leverage from these producers, and that's the reason to own a gold stock. The other reason is you have the potential for a discovery, and a discovery can add a significant amount of value to a company, particularly if it's not a large producer, if it's a junior or intermediate producer and they make a discovery on a property. That's a significant home run for the shareholders. So as I mentioned, gold's been above 2,000 an ounce here 4 times in the last year, and I think it really has to push through 2,100 to get back to reasonable valuations. And right now, the valuations have been pretty depressed. This chart here shows the net asset value for the senior producers going back in time. And from this chart, you can see that the NAVs have varied from 0.8 to 1.6 times this cycle, averaging 1 time. And these are consensus net asset values based on all the analysts' consensus NAVs. But in the last bull market from 2000 to 2011, the NAV multiples got as high as 2 times consensus NAV. So there is significant upside from where we are today. I mean, the stocks are trading at 1 times NAV. And, really what drives the share price valuations is a higher gold price, breaking out to higher highs. And obviously discovery is the other way that you can make significant capital gains in this sector. So this shows the senior producers. And last cycle from 2010 to, or probably 2000 to 2011, the NAVs were as high as 2 times, so they can get pretty high. This is the net asset value consensus NAVs for the intermediate and the juniors. And as you can see, the multiples are lower. They're sort of 0.4 to 0.8 times consensus NAVs, averaging around 0.55 times. The multiples are lower, but these smaller producers do offer more leverage primarily for 2 reasons. One, the potential for a discovery, which can have a significant impact on the share price. And 2, for the opportunity that it could be a merger candidate or an acquisition candidate by a larger company looking to add scale, looking to replace reserves, or looking to add a pipeline of projects into their portfolio. So that's the reason the intermediates and the juniors are interesting, because often the seniors are acquiring these companies, or an intermediate acquires another intermediate to make a larger company, and you can get a premium paid. And, the seniors are trading at 1.2 times today. They can afford to pay a premium to an intermediate or a junior that's trading on average 0.6 times NAV and not be dilutive. This is another metric that I use for valuing gold stocks. In addition to the price to NAV, we look at enterprise value to cash flow, and this shows the cash flow EV to cash flow numbers for the GDX, which is the index for the producers, going back over time. And you can see that the multiples do change significantly over the course of time. And the multiples do expand as the gold price moves higher, primarily because the margins are expanding for these companies. Their cost base is relatively fixed unless there is some change in their operating costs or their grade profile. But the lower cost producers also do attract a higher multiple given their higher operating margins for any particular gold price. So if you're looking at investing in a gold stock, you will definitely see that the multiples are higher for the lower cost producers because they have that inherently higher margin. But the leverage as the gold price goes higher comes from the higher cost producers. And the average EV to cash flow in this cycle has been about 13.6 times. There's been a lot of variation, as you can see on this chart. That depends on the cost structure, the political risk, the technical capabilities of the management team running the company. And in the last cycle from 2000 to 2011, those multiples pushed up to 20 times. So there is significant room for expansion in this sector. This is a chart just showing kind of the life cycle of a mineral discovery. And the reason I put this up is, as I said, there's really 2 ways to make money in this sector. One, you need to buy the stocks at the bottom of the cycle and wait for the gold price to rally. Ideally, you would own a dividend-paying company because you would then be paid a dividend to wait for the gold price to move higher. And the second way you make money is through a discovery. And really, though, when you get a discovery, it takes a long time for that discovery to be, well, A, found, B, drilled out, C, go into engineering to get a feasibility study complete, and then to be able to deliver the permits and build this mine. And the life cycle can be very long. It's decades these days. And, really, I think that's one of the ways you can make money. I think it's easier for investors that don't have a lot of experience in the sector to look at the producers, and you can easily find, consensus multiples for NAVs and consensus multiples for EV to cash flow for these companies. And based on that, you can make an assessment as to which names you want to own. If you are more risk averse, it's pretty easy to own the index, the GDX, as I mentioned. Or the other way that you can play the space is you can own the royalty companies. They are a much more conservative way to play the space because they basically make money. They don't have any actual operations. They make money through royalties on production from other companies, and those royalties they've purchased over the course of time. And there's many names in the royalty space now. The largest are Franco-Nevada, Wheaton Precious Metals, and Royal Gold, but there are a lot of mid-tiers as well that you can look at. So this chart, I'm just going to show a couple of case studies here of stocks that have delivered discoveries and have delivered pretty significant returns for shareholders. This is Rupert Resources. They have a project in Finland. It's a pretty good jurisdiction. This company made this grassroots discovery in 2020, and they've been working away. They've delivered a PEA, but you can see there was pretty significant price appreciation when this discovery was made. And this is a company that actually has one of their largest shareholders as one of the senior mining companies, Agnico Eagle, which owns about 14% of the shares. And that's often a way to get some insight if you're not really that experienced in the sector. If you see a major buying an equity position in a junior explorer, that's probably a pretty good indication that it's a validation of the potential of the project. It doesn't mean the exploration is going to pan out and deliver an economic deposit. In this case, it did. Agnico was a shareholder very early on in this company, and they continue to maintain their pro rata share. And I think it's likely that at some point when this asset actually gets developed, it will not be developed by Rupert. They're a small company, and it's difficult for these smaller companies to raise the necessary capital to build some of these mines, which can be hundreds of millions of dollars of capex. This mine is going to be well north of $500 million to build out, and the market cap of Rupert is only about $650 million. So ultimately what happens is these single asset development companies get sold to a producer that needs organic growth, and they can generate significant value of it by executing, by financing, by building it, by completing the permitting. If the junior hasn't, or if the explorer hasn't completed the permitting, and pushing the project into development and ultimately into production. Here's another example. This is a company called Filo, and this company's made a pretty significant copper gold discovery in Argentina, and you can see the significant share price that's appreciation that's happened with this discovery. And in the context of the gold price hasn't done a lot, but this stock has had some very significant share price appreciation, and guys that were in early on in this company made a lot of money. Now, this was a company that was backstopped by a management team that's very familiar with the resource sector. It's the Lundin family, and that's the other way to get some insight into which companies in the developer or explorer stage that you may want to back. Some of these management teams are very experienced and have a better track record than most. But, the reality is 1 in 100 prospects actually develops into any kind of a resource. And of the ones that develop into a resource, there's only a fraction that actually make it into production. So it is a very risky way to invest in the sector. And as I said, the better way, in my opinion, for people that aren't that familiar with the space is to look at the producers. They do pay a dividend. You can be paid to wait for the gold price to go up. Buy the stocks when they're out of favor, when the gold price is low, and then you can also look at the royalty companies, as I mentioned. And I should go back. I should also mention for Filo, BHP, which is the largest mining company in the world, actually invested $100 million into this company after the discovery was made to acquire a 5% interest. So there's another validation of this deposit. This is going to be a very large deposit. It will get mined one day. Filo will not be the company to build this asset and develop it. It's going to be owned by a major for sure. And this is another example, Marathon Gold. This is a project in Canada, in Newfoundland. It's the deposit was actually discovered while the original discovery was back in the 1960s. It's now in construction. It's taken a long time to get from discovery through to development and ultimately production. And part of the reason it takes a long time for these deposits to get into production is the junior that owns it often doesn't have the capability to finance the project the way they would like to. Access to capital is difficult, especially if the gold price is low. And it gives investors a lot of opportunities to own shares in a company like this, even after the discovery is made. I mean, if you looked at the Rupert slide earlier on, you can see that the stock has come off significantly from when they made the discovery. And all that's happened is the market, was assuming the discovery would be a lot bigger than it was, and it probably still can grow, but it did not meet the expectations of the market, and the hot money is left, and the stocks come off. It gives people an opportunity to come in at a lower price at a future point in time. So Marathon, as I say, has been a very long time to get to where they are today, and they just finally announced a merger, a friendly deal to merge with a producer. And the reason for that merger is that producer is bringing a lot of cash to the table and development expertise and construction expertise and operating expertise, which Marathon doesn't necessarily have. And it allows them to complete the build out without any risk of having to come back and finance in the market. So this has been a story that there were multiple opportunities to invest in this name and make money, as you can see on the chart. And now they're actually, I think, finally got a solution here that's going to give the shareholders some pretty good value over the course of time. This will be a good ore body once it starts mining. And the last one I wanted to show was Gold Standard Ventures. This company was acquired last year by Orla. This project, delivered some pretty exponential returns for shareholders through the discovery. It's based in Nevada. It's a good project, but it's going to take a while to permit. It is in the permitting phase right now, but it's going to take 3 or 4 years to get it permitted, and then probably a year and a half to build this project. So it isn't anywhere close to production yet. But as you can see on this chart, even after the initial discovery, there were 3 or 4 opportunities to make good money in this stock. Particularly in the middle of the chart there before the big run, that was an opportunity when the stock was down, the gold price was down, and you would just buy the stock and be patient and wait for the gold price to appreciate. And it was a pretty good return for people that did that. So that's the end of my talk. And I think just in conclusion, I think the best way to look at gold stocks, producers particularly, is to look at their multiples to their net asset value, look at their cash flow multiples, make sure their balance sheets are in good shape. And the other item that you need to pay attention to is management. But generally in the intermediate and large cap companies, the management teams are pretty capable and able to deliver value. Obviously, investing in a lower cost producer gives you better cash margins today, but it gives you a bit less leverage as the gold price pushes higher, which is when you would want to own the producers that are higher cost. And then on the second way that people make a lot of money in the sector is on the exploration side, and I've shown some examples of that. Generally, that's more difficult to pick those winners because exploration is a very risky game. But if you can back good management teams and management teams that have backing from, say, a producer who has bought shares in the company, in the case of Rupert, and in the case of Filo, that obviously is another validation of the strategy and gives you a little bit more comfort that you can own the stock and hopefully will make money on it. But I think really you need to try and buy these shares when the gold price is breaking out and own them when they're out of favor. And then when the markets get exuberant and put big multiples on these stocks, that's when you should think about trimming your positions. I'll thank you very much for your time, and I appreciate it.
While we wait for the other participants to join us, I just want to thank Marianne Crichton of Hatch and Boyd Davis of Kingston Process Metallurgy for setting this up. Also, John Reed from World Gold, driven research head at Capital Light Research, and of course, Terry Smith for their contributions today. We're going to do a Q&A session now, so please hand on the side of your screen, send any questions that you want to be asked, and we shall ask them. I think we are going to be missing Kerry Smith from this one. He seems to have found something else to do. So, John, welcome. How are you?
No, very well, thank you. I would say I'm freezing cold in London, but then Canadians would laugh at me, so I probably won't.
Exactly. No point. -6 means nothing to them. Right. So I'm just going to, if you don't mind, I'm going to bounce off both of you. A few questions that have been sent in already. Now, John, I'm going to pick up on something you said. You said gold is not correlated to equities. Now, it's got its pluses and minuses in that sense. You'd argue pluses at all times. So what is an investment in gold equities then? What are we actually investing in?
Both gold and equities, and that's one of the difficulties there is that I've seen events over the last 20 years where you've seen something happen in financial markets, equities have fallen, the gold price has gone up, and gold equities have gone down. So it's one of the reasons why we differentiate very much between gold and gold equities, and we focus very much our efforts on gold. It is a much purer bet than gold equities, where you have all sorts of other factors as well. Now, some of those can be really positive: exploration success, development, you name it. All sorts of things can go right in mining companies, and there's lots of things that work against them as well, like cost inflation, I don't know, geological risk, you name it. I mean, anyone that's been involved in gold mining companies over the years will have seen all manner of good and bad things that can happen. So the work we do focuses very much on gold, and thinking about that as a strategic allocation in a portfolio, and something that offers genuine diversification and the potential to improve portfolios. That's not to say that gold equities can't be great investments. They certainly can, and there's been some brilliant success stories over the years, but they're not just pure gold plays.
Okay, and Chantal, just let's warm everyone up. We're going to ask you a question. So you talked about the diversification of your gold investing. You talked about some of the ways that people could do that. It's a nice entry. People haven't got there yet. With the data that you guys have been analyzing and writing about, what does risk adjusted mean to you in terms of the weighting of the different types of gold investments you can get into?
Yeah, so I default back to what John said earlier. It depends on, the portfolio, the risk, and the overall portfolio. For, whether they, how much of pure gold you'd want, like, you can do gold ETF, gold bars, and you have those compared to gold equities. And then you also have, within the gold equity space, there is a lot of different risks within just the equities themselves. An exploration company is a much more risky asset than a gold senior producer, for example. So it really, and it's always tough when you say, well, it just depends on the risk tolerance of the investor, but it really does. When you're looking at a gold exploration company, even those, the success ratio is fairly small from the very beginning. So like Kerry said in his presentation, you want to find good management teams to back, kind of do the research on that side. And then when you go into, into the more senior companies, you do have an advantage that they go up generally both in a gold market. But if you have a general equity rally, a lot of times you'll see those go up somewhat also.
Okay, so I think generally in investing, certainly for the retail side of this this audience, a blended approach to your portfolio is always sensible when it comes to risk. And John, back on you. we equity investors have been slightly confused by the market for the last 3 years. I know you're looking a little bit broader than that with physical gold, etc. And your producer members would be fine with that. But have you been slightly as confused as we have in terms of the old signals, the old behaviors would have suggested a certain course of action and a certain result with the equities, or response from the equities? It's been difficult the last 3 years to kind of read how to play the market, it seems.
And when you're talking about the market, I presume you're talking about the gold equity market.
Indeed.
Yeah, not really an area of my expertise anymore, to be frank. I have worked at funds where we had large positions in gold mining equities, but that was some years ago, and I don't spend as much time looking at them, certainly, as I did. What I would say is that, and if you take a longer term view, and if you look at the larger producers, they did derate tremendously, particularly around probably after the global financial crisis, so sort of 2009, 10, 11, 12, underperforming the gold price tremendously. I mean, just casually looking at the performance since then is that the share price performance has been broadly in line with the gold price, sometimes outperforming, sometimes underperforming. But what you haven't seen coming through is a big re-rating. So speaking to some of my former equity colleagues, they've said that basically what seems to have been happening is as margins, EBITDA margins or all-in sustaining cost margins have increased, so that's been reflected in the share price, but you haven't actually been seeing investors prepared to pay an increased premium to own the gold names. So, I mean, look, there's a lot of things been going on. I mean, one of the things we track at the World Gold Council is the industry's all-in sustaining costs. And, inflation has been an issue for the global economy. It's certainly been an issue for mining companies and gold mining companies too. So, maybe that's the concern that investors have. It's all very well to see the gold price going up, but if it's going up in a high inflationary environment, maybe those benefits haven't been, coming to the bottom line.
Yeah, I think that's fair to say. I think the cost base has risen as in line with the gold price. So perhaps margins haven't changed much, so therefore valuations are perhaps need a little bit of reevaluating. Chantal, what are the red flags for you at the moment in the market across the board?
Just for gold in general, or I would, right now we would say there's more, what you'd maybe say green flags. There's more bullish factors in the gold market right now than there are red flags. I think that the one thing is if there is a severe global recession, in general, you would see gold decline right at the beginning of a recession. But as policy starts to really change, then the gold market will, then outperform generally. So it's, there's that brief part. But I would say as far as our kind of bearish factors, that would be the biggest one coming up in 2024. And, but we do think, right now we're in a bull market. We think it's going to continue. Of course, there's ups and downs in a market anytime, but we do think it's going to continue for several more years. And there's, a lot of reasons on that side as far as, geopolitical risk is one of them. We think policy is going to ease this next year, that monetary policy is going to start to turn. The dollar,
right.
The U.S. price of gold is, of course, correlated with the dollar, so I think that's going to go down. Sorry about that. I cut you off.
No. I think unlike gold, unlike oil, I think gold's correlation to the dollar is safe. John, I saw a chart in your presentation which talked about the increase in buying over the past 3-4 years. Obviously, this year has been very, very strong. You probably saw the piece in the FT with regards to that commentators views that perhaps next year we'll see that drop off a bit because they've topped up on their gold inventories, haven't they?
Central banks have bought a lot of gold in the last couple of years, really an unprecedented amount. But if you look at the two of the three biggest buyers this year, China and Singapore, they still hold only around about 4% of their reserves in gold. So if you compare that to developed market central banks that might have 30, 40, 50% of their reserves in gold, there's plenty of room for some of the largest buyers to keep buying. for years, if not decades. So it really comes down to, what are central banks trying to achieve here? They are notoriously uncommunicative about why and how much gold they're going to buy. But my sense is that if you see us moving towards a multipolar world where the US economy and the US dollar isn't the only principal reserve asset in the world, then maybe some of these up and coming countries might think that they want to have similar amounts of gold. So, it's really difficult to judge. In the end as well, central bank purchases are very often politically motivated as much as economically or financially motivated. And, I think that we're in a situation where we're going to see high levels of tension between China and perhaps some of the historic economic powers as the Chinese economy continues to grow and become more important.
Okay, and Chantal, I know we don't have, unfortunately, we haven't got Kerry here, who would in the great commentator in terms of the equity side of things. I'm going to ask an equities question of you, Kerry, if you don't mind, which is that, over the last 10, 15 years, institutional investor ownership of gold mining equities is relatively high. Is there an explanation for that, given its kind of rather humble performance over the last 2-3 years?
Yeah, I think, institutions are also looking for ways to diversify, ways to do, to invest in other things. Equities are one way to do that. And, like John said, it's not a pure gold play, but you still do get gold exposure through the equities. So that would probably be, the main reason. I think also with the mergers and acquisitions, you have some gold companies that are actually sizable, because one of the difficulties you have with institutional investors in, gold companies is that they're not sometimes large enough in order for them to invest in, compared to, some of your, your FANG stocks and such. And so with that, you're starting to see some sizable companies come out, and it gives, an advantage, that they can attract a little bit more institutional investors. I also think gold company management companies have done a good job after, the run up where equities did enjoy that premium over the gold price, up until the financial crisis. They had that real sell off. They underperformed from 2009 to the end of 2015, basically. And you had management companies really going in and changing their strategic, management styles to really create shareholder value. And so since 2016, kind of when we put this bull market starting at the end of 2015, beginning of 2016, management companies, I think you really are seeing that advantage and that discipline that these management teams have brought in to the companies. So really, I'd give it those two reasons right off, that they're getting a little bit more sizable, and management companies have done a good job in making it more attractive for institutional investors.
Do you agree with that, John?
I think that's right. I think one of the things I pick on what Chantal said there is size. I think is relevant. If you think of the total market capitalization of the gold equity sector now, I don't know what it is. It's a few $100 billion. Isn't Apple close to 2 or 3? I don't know. It's huge. So you have this huge, have this big sector, lots of companies, lots of complexity, lots of operations around the world. Yet it's only a few $100 million in $100 billion, I should say, in market cap. And I know I suppose it's a chicken and egg situation, but I think I suspect investors feel that they don't have to have a view on gold equities. The generalists particularly. I think as well, and from what I understand, again, not following this as closely as I used to, there's been a lot of specialist gold equity funds that have closed in the last few years. And I think that might be playing a role as well, particularly with some of the smaller companies.
Okay, and I was talking, I think, with Randy Smallwood at Wheaton 2-3 weeks ago, and obviously it was with regards to the Aegis Elba piece that they put out, John. And you're not for profit, funded by your members. What is the job that you've been set or tasked to do? I mean, gold's been around for a long time. Surely everyone understands the value of gold.
I mean,
What are the conversations like?
What are conversations like? Very mixed. I mean, all you can see to a large extent that people don't understand gold or don't care about gold or dismiss gold when you look at some of the mainstream financial market commentary that you'll see in papers like The Economist, like the Wall Street Journal, like the Financial Times sometimes. I think a lot of, and everybody's younger when you get to my age, but I think a lot of younger journalists, younger finance professionals see gold as something archaic and from a distant past and not part of the modern booming global financial economy. And that's been fine, I guess, over the last 40 years when all you've really had to do is own equities with a bit of bond hedging, and your portfolio's done really well. But as events of the last couple of years have shown, bull markets, particularly bond bull markets, don't last forever. We had a 40-year one that ended in 2021, and that's caused people, I think, to reassess what's happening. So our job is to go out there and say, look, gold isn't a fringe asset. It's not a conspiracy metal. This is something which has been valued for thousands of years, fits into a portfolio, has unique diversification attributes. And as I've said, I think about 3 or 4 times yesterday in different conversations, if you had an appropriate amount of gold in your portfolio over the last 5, 10, 20 years, or since 1971 when we ended the Bretton Woods Agreement, your portfolio would have benefited from it because of the diversification that it brings, because of the returns, because of its ability to help protect your portfolio against shocks.
And what has it been up against? I mean, saying that there's open to either of you. And perhaps Chantal first. What has it been up against? Because it seems like you talk about younger generation, John, who have made a lot of money in the tech space for the last 10 years. Obviously, come off in the last 2 years, but generally, as it's been risk-off environment. But gold feels like old school. Tech feels like where it's been at. Do institutional investors think the same way? Because I take your point. Yeah, Apple's worth $3 trillion company.
Sure.
And if you combine all the mining companies into one, they probably wouldn't even be half of that. So it's very small. But as you say, maybe there's money to be made. But do people get it?
It's a really interesting question. Sorry, I'll jump in there, Chantal.
Yeah.
It's something I've thought about a lot.
Yeah.
Retail investors, to me, they tend to buy stuff they think is going up, and that's not pejorative. It's at the heart, I guess, of what the basics of investments are. So if you see a sector that you think is going to do well, you pile into it. Institutional investors do take a very different view. They need to build portfolios rather than just pick individual investments. And when you start thinking about portfolios and you start thinking about diversification, then gold fits much more naturally into it than whether you're just picking 1 or 2 or 3 meme stocks or tech stocks that you think are going to do really well. And one of the things that I've been speaking internally about here, in a way, when it comes to making the case for gold for retail investors, actually what we need to do first is make the case for diversification. Don't have all your eggs in one basket. You may love tech. That's great. Tech isn't going to do well every year, as we've seen over the last couple of years. So think about diversification. And if we can educate retail investors into thinking in portfolio terms and thinking about the benefits of diversification, we actually won't have to explain very much about gold because it will fall into it naturally. You'll just have to show them the historic data and they'll get it. But I do think that retail investors tend to buy stuff that they think will go up.
Okay, Chantal?
Yeah, I think that's a good point. And the only thing I'd add is, the diversification and actually thinking as a portfolio. Because sometimes when you're talking to somebody about, gold and adding gold, it's like they go to this all or nothing kind of headspace where, it's they're thinking about tech stocks. So they want to have it all tech stocks. So adding that diversification, thinking about a portfolio, having 5 to 10% of that portfolio in gold, and still, having their tech stocks as part of the portfolio, having, maybe some other sectors in there too, as, John said, would definitely benefit their portfolio over time.
Okay, and Chantal, I'll stick with you for a second. In terms of, I know you've talked about a blended approach to this, but do you think if new entrants to gold, do you think what should they be leaning into? I mean, I know blended approach is great, but if you had to pick one as a starting point,
if I had to pick one, I would say if they're a very new interest, not knowing anything about them, I would say more pure gold that go into gold ETFs is one of the ways that you can get exposure of gold in the actual portfolio. It does make it so that you are buying the gold. You're not you're not trying to pick the companies. If you want to exposure to the companies, then there are a lot of great mutual funds out there that will do the picking, and you can get a variety for you can kind of then you get the exposure to a lot of different companies instead of trying to pick one. But if somebody's new to the market and they just want gold exposure, then I'd say, yeah, go for gold. Go for the kind of the pure play there. I don't know, John, do you have any?
Yeah, I mean, I've got some colleagues I've worked with for getting on 30 years now, and one of them, I won't mention his name on this call. I'm not sure he'd be too happy about it, but he's always said to me, look, when it comes to gold mining companies, you can't just own one. Okay, you have to have a diversification because the company risk level is high. So you've got to pick a few. Now you can take views. You can say, do I want to own a major gold mining stock? Do you want to have an intermediate, maybe a developer, or even an exploration company? There's different types of gold companies that you can own as well. They have different risk reward characteristics. But I think I can't personally give any single stock recommendations. And all I would say is that, the gold mining sector, and sort of echoing, I think, what Chantal said earlier, the gold mining sector seems to have changed its behavior considerably compared to the last bull market in gold we saw around and after the global financial crisis. And the underperformance of the gold price certainly seems to have stopped. So I think there are certainly opportunities to be had there, but you're going to have to consult equity brokers that can give you more specific recommendations, I think.
Right, but okay. So here's a question which talks about the market, and it affects everything. It affects whether you're physical gold ETFs or however you want, or equities, or however you want to invest into the space. Is the COVID inflation period that we've just been through is affecting everyone from the great and good through to the not so good. So producers right the way down to explorers. We've seen cost inflation. We've seen some good and some bad M&A. We've seen dilution across the board, shrinking reserves across the board. Geopolitical challenges are happening across the globe. It's almost irrespective of which country you're in sense of permitting issues, licensing, and etc. taking a lot longer now. The production levels. I'll take your word on it, John. But it's getting harder for these companies to actually get the answers, replace the reserve numbers, and a lot of fragmentation. It's a tough business at the moment. What's the future look like? Do we need a shakeout in the sector? Can we produce those additional answers? Are they going to be needed, John?
Yeah, I mean, are they going to be needed? Well, no. There's enough gold out there. You don't need to produce an increasing amount of gold every year. Although mining companies across the world seem to have managed it most of the time over the past 30 or 40 years to increase production. I hear what you say in terms of production profiles of mining companies. We get data from our partners, Metals Focus, that project what gold production will look like over the next 10 years based on listed companies and their reported projects. There is a bit of growth likely to come, they say, in the next year or two, but then we're going to need to find more discoveries. As you point out, gold's getting harder to find, and if you do find it, then you've got to permit it, and then assuming you can spend the money, bring it into production, you've got to keep hold of it. So it looks increasingly difficult to be a gold miner. Having been one, I can tell you it's never been easy. You do get benefits from time to time when the price goes up rapidly, but they don't seem to stick around for very long, and it becomes hard again very quickly. But look, the difficulty in discovering, permitting, building, and keeping your hands on gold production will reflect also in the outlook for the price as well. If we were in a market where gold production could grow at 5% every year very quickly when the price goes up, then the outlook for gold would be considerably weaker than it is. So we're in a market which is, ultimately gold is rare, gold is scarce. And that scarcity and difficulty in doing the business is one of the reasons why it's highly valued.
Chantal, you can have the final word.
Yeah.
What can you say?
Yeah, I think that, that's a good point, is that if gold does, if gold companies, if it was easy, there would be a lot more of it, or if it was very abundant, or, and the price wouldn't reflect that non-scarcity then. So, gold, it is increasingly difficult, it seems, for gold companies, especially in the discovery. There hasn't been any major discoveries for, about 3 years or so. So it is, and that's one of the things that really keeps it as a great investment that it is the scarcity of it.
Well, okay, and I'd like to thank you both, Chantal and John, for your contribution today. Thanks for joining us for the Q&A. I'm sorry, folks, that Kerry Smith at Haywood couldn't make it today, but as W.C. Fields once said, never worked with children or animals, and I'd add senior mining analysts too. So I appreciate your time today. We'll see you all soon. Thanks.
Thank you very much.
Thank you very much.
Good morning. My name is Lisa Davis, and I'm the CEO of Pear Tree Securities. Pear Tree's core business is flow-through financing for donation purposes. This variation of the traditional flow-through financing model is now the source of most of the equity capital raised for mineral exploration in Canada, and Pear Tree is the single largest source of flow-through share capital. With the challenging markets we're faced with for capital raising to fund the expensive work of gold exploration, I'm pleased to have this opportunity to provide some insight into one of the few effective ways to raise the equity needed to fund gold discoveries. One of the things that's contributed to Canada's success as a hub for mining finance is the flow-through share regime. Exploration companies, which are non-revenue producing, generally have limited options for financing other than raising equity. The high-risk, speculative nature of investments in junior exploration companies makes attracting equity capital very challenging. Such companies may not generate income for many years, limiting the use of the tax deductions resulting from its exploration activities. Flow-through shares allow issuers to transfer certain exploration expenses to the investor, who can claim the deductions directly. My presentation today will explain the key features of a flow-through share offering, how flow-through share financing has evolved over the past couple decades, and what current opportunities and challenges we have in front of us. While there's been a recent shift in focus to critical minerals, the majority of flow-through financing has generally been directed to gold exploration. The flow-through share mechanism was introduced into the Income Tax Act in Canada over 50 years ago. In 2000, a 15% credit against tax otherwise payable was added for subscribers of flow-through shares, where the proceeds are used to fund grassroots exploration. In 2006, capital gains tax on a donation of publicly listed securities was eliminated. Previously, even though a donor was giving away stock, capital gains tax was payable on the difference between the acquisition cost of the securities and the fair market value at the time of donation. This was a game changer for charities. This led to the introduction of so-called charity flow-through financing, which I'll be discussing in more detail in a moment. Most recently, the mineral exploration tax credit was doubled to 30% for 15 critical minerals, unfortunately not applicable to gold. This is a chart that breaks down the equity financings completed through Canadian stock exchanges for mineral exploration in Canada between flow-through shares and non-flow-through shares. You can see from this chart, the flow-through share financing has consistently been the largest type of equity financing to fund exploration in Canada. Since the advent of charity flow-through financing, there's been a very clear upward trend in terms of the proportion of flow-through share financings done as charity flow-through financings. A decade ago, the majority of flow-through shares were purchased by retail Canadian investors, mainly through flow-through limited partnerships. These partnerships are now a pretty small part of the market. Clearly, the opportunity to participate in equity financings by early-stage companies, other than through charity flow-through financing, has become very limited. Flow-through shares are simply common shares with tax features available only to the original Canadian resident share subscribers. When sold, the tax benefits stay with the first owner of the shares, and upon a subsequent sale, the shares are simply common shares in the hands of the purchaser. The proceeds of sale of the shares must be spent on expenses that qualify as Canadian exploration expenses or Canadian development expenses. As I mentioned earlier, the funds raised from the sale of flow-through shares must be used on a specific set of expenditures prescribed by the Income Tax Act. This slide sets out the types of expenses that must be incurred for a company to be able to renounce those expenses as Canadian exploration expense in favor of flow-through share subscribers. 100% of the subscription amount of the shares will be deductible in the year in which they're purchased, so long as the issuer spends the funds raised on qualifying expenses. In addition, if the funds are used for the earliest stages of exploration, the investor, if an individual, will be entitled to a 15% federal investment tax credit and may also be entitled to additional provincial incentives. The determination of whether an expenditure qualifies as Canadian exploration expense is based on a purpose test. You really have to look at whether the purpose of the expenditure is to determine the existence, location, extent, or quality of a mineral resource. Expenses that are incurred a little later on in the business cycle of a mining company also qualify for flow-through treatment, but the tax deduction of a flow-through share subscriber has to be amortized over time, generally 30% on a declining balance basis. These expenses are generally the costs of developing and building a mine, but don't include the costs of acquiring a resource property or any depreciable property. There are far fewer flow-through share offerings for the funding of Canadian development expenses, since the tax incentives aren't as attractive to retail investors. However, Canadian-controlled private corporations, operating or investment companies may have a tax profile that makes these investments quite attractive. The province of Quebec, with its own separate tax regime, is the most attractive province for flow-through share investing in terms of the after-tax cost of investment, although a few of the western provinces have increased their provincial credits, so they're not too far behind. This is a map that shows the after-tax cost of an investment in flow-through shares based on a $1,000 subscription. The orange highlighted amounts are for minerals other than the 15 designated critical minerals, so that would be the after-tax costs for a flow-through investment to fund gold exploration. There are several components to the tax benefits that reduce the net cost of an investment in flow-through shares. This slide shows the net cost to an individual resident in Ontario of an investment made to fund Canadian exploration expense in the province of Ontario. This example also assumes that the funds are used for flow-through mining expenditures, which qualify for the 15% mineral exploration tax credit that I mentioned. The example assumes a cash outlay of $1,000 to invest in flow-through shares. In the first two orange bars, you can see that the investor can deduct the full $1,000 from his or her income. This has a value of approximately $535 when looked at the combined federal provincial tax rates for an Ontario individual tax at the highest marginal rates. Then in the gray bars, the first of them, number 3, the mineral exploration tax credit, is the 15%, which reduces the tax otherwise payable by an individual. So this would be valued at $150, but the base on which the mineral exploration tax credit is calculated is reduced slightly when there's other government assistance. In this case, the fourth bar, which is the 5% Ontario provincial tax credit. And finally, the green bars 5 and 6 show the amounts paid as the mineral exploration tax credit and the 5% provincial tax credit in the year of investment are actually taxed in the subsequent year. The bottom line is that the net cost of a $1,000 investment in this example is $375. As I alluded to earlier, there's a significant limitation to the traditional flow-through financing method. The investors, whether they're purchasing directly or through a flow-through limited partnership, must be resident in Canada and also must be individuals to be eligible for the 15% tax credit. So the flow-through share regime was traditionally a very retail Canadian product. In charity flow-through financing, which is illustrated on this slide, there are 3 simple steps. Canadian subscribers purchase flow-through shares. As the original purchasers, they are entitled to the tax benefits associated with the shares. The subscribers for the flow-through shares then donate their shares to charity. They receive a further tax credit for the value of the donated shares. The charity then immediately sells the shares to a third-party investor. Since flow-through shares are simply common equity in the hands of a subsequent purchaser, the universe of investors is significantly expanded to include any global institutional or strategic investor. The sale to the end buyer in the transaction will settle immediately following the issuance of the shares to the initial flow-through subscriber, so the end buyer is in the same position they would have been in by participating in the offering directly with the issuer. In this real-time example, you can see the leverage gained by using the charity flow-through structure. In this actual example of a transaction arranged by Pear Tree, which just closed earlier this month, the end buyers were able to acquire shares issued for approximately $6 million to Pear Tree. So Pear Tree's clients paid approximately $6 million to Mayfair Gold whereas the end buyers paid a total purchase price of only approximately $4.3 million. So in this transaction, Mayfair received a premium of almost 38% to the previous closing price on the TSX Venture Exchange, while institutional investors acquired the shares at a 2% discount to market. One thing I would like to add is that there is a terrific additional benefit to this structure, which is that many, many dozens of Canadian registered charities also benefit with millions of dollars going to support important causes all across the country. And these are just a few examples of some of the charities that have benefited. So out of all of this, there's many benefits to both issuers and investors. The key issuer benefits are that the issuers receive a premium share price when they undertake a charity flow-through financing. There's far less dilution, and no fees are charged by Pear Tree in structuring this type of a transaction. From an investor's point of view, there are many opportunities. There's an expanded choice of offerings for global investors who wouldn't otherwise be able to participate in a traditional Canadian flow-through share offering. Better returns for the end buyers, and all of the funds raised go into the ground. There's a discipline imposed by the Canadian Income Tax Act, which requires the proceeds of an offering to be spent on specified exploration expenditures. So whether you're a flow-through share investor or an end buyer, the combined benefits of a tax-advantaged structure, more funds for exploration, and less dilution accrue to all participants in this type of financing transaction. I'd like to finish off by just touching on one recent development in the Income Tax Act in Canada with respect to alternative minimum tax, or AMT. AMT rules limit deductibility of certain expenses and credits to ensure high-income earners pay a minimum amount of tax. Under new proposed rules, this alternate tax calculation, which kicks in if your taxable income would end up being under $173,000, adds back 100% of capital gains and allows only 50% of certain non-refundable tax credit, like the mineral exploration tax credit and donation tax credits. So even though the funds are used for taxable activity elsewhere, the flow-through share cost base is deemed to be nil, since flow-through share subscribers get to deduct the full subscription price in the year of purchase. Applying the proposed new AMT rules could reduce the amount of flow-through share investment by 1/3, since about 50% more income would be required to absorb tax deductions and credits without having to pay alternative minimum tax. Because of the disproportionate effect of the proposed changes to AMT on flow-through shares, we're recommending to government that the capital gain from zero to the actual purchase price of flow-through shares not be added back in the calculation. There is material available on Pear Tree's website about the harmful impact of AMT on the mineral exploration industry. And if you want to add your voice to help government understand why they should give our recommendation serious consideration, I would strongly suggest that you take a look at that material. And those are my comments for today. Thank you for the opportunity to make this presentation.
Good morning, everybody. I'm going to talk today about the ESG considerations in gold investing. So whether we talk about ESG, corporate social responsibility, or sustainability, in essence, we're talking about a set of environmental, social, and governance indicators that are used by an array of stakeholders, investors, communities, employees, government, to assess the performance of a company or an operation. In fact, the mining industry has been responding to ESG concerns and considerations since the environmental movement of the 1970s. It's really about responsible behavior and the use of risk management to make decisions. And from an investor's point of view, global markets are taking a deeper look at what drives long-term value in business, using metrics not typically found on a balance sheet to more precisely measure and communicate a company's values. Social acceptability has become a non-negotiable element for projects, so communities want to know who the promoter is, its environmental and social practice, and how it governs its practices. They will then be able to assess whether the company can be trusted, a trusted neighbor and partner for the future. Nowadays, potential employees also will review the ESG performance of a company to see if their values match the company culture and values. In this era of talent scarcity, companies with a good ESG record will have an advantage. And today it's not enough to fulfill obligations, legal or otherwise. We now have to also meet societal expectations. Since these are changing with time, the ESG landscape is also changing, sometimes at a rapid pace. So who's interested in ESG? There is a whole array of stakeholders, both on the input side and on the output side. In the inner circle, you'll see that near the mine, employees, communities, and First Nations are major stakeholders. It's important to understand that given the variety of stakeholders interested in ESG data and performance, the information and the conversations on the topic need to use more than one channel. It's no longer adequate to only publish a CSR report or a sustainability report as a means of communicating our ESG performance. The use of social media, the use of videos have increased over the last few years. And in fact, nowadays, there is no barrier between the information provided to shareholders and the information that is available for communities, employees, and First Nations. However, there is always a need for personal communication. It's very important to keep that as well, especially with employees, communities, and First Nations. So how does ESG create value? If we look at the component of ESG is drive long-term value for the business, it drives value through positive outcomes for a wide variety of stakeholders. For example, for employees, it could lead to increased engagement, increased innovation, productivity, retention and diversity. When we're talking about communities, it could contribute to the maintenance of the sometimes elusive social license to operate. For suppliers, it could increase the trust in the company and its reputation and be seen as a good business partner. For shareholders, it shows an increased focus on performance and risk mitigation. In the end, it creates enhanced shareholder values. What are the major areas of focus under environmental, social, and governance? We have under environment topics such as climate change, water, emissions to air, to water, to land. Under social, we have topics such as human rights, employees' relations, community relations. Under governance, we have topics such as cybersecurity, a really hot topic nowadays, composition of board, executives' pay, with the say on pay that we have that is subject to shareholders voting at the annual general meeting. This is a very important piece of information. So let's look at indicators on these general topics, but more specific to mining. For water, for example, what are we talking about? We're talking about acid mine drainage, sharing of water resources with other users, especially with the climate change. The effects of climate change could be water scarcity in some areas. We're looking at emissions of contaminants in water. In terms of land, we're talking about biodiversity, conservation of biodiversity, waste management, including tailings management, which is a high-risk area, ground contamination from spills. In terms of air, we're talking about air emissions, including greenhouse gases and dust. On the socio-economic front, we're talking about job creation, skills development, and even going to local infrastructure and housing, because nowadays mining has to contribute locally to infrastructure and housing. In terms of health and safety, we're talking about fatalities, injuries, as well as industrial illness. In terms of quality of life, we're talking about noise, vibration, visual impact of our operations. All these topics are ESG topics, and they are indicators of the environmental, social, and governance performance of a company. So with so many topics that we need to manage, how do we do it? How do we manage these topics? For that purpose, the World Gold Council has developed the so-called responsible gold mining principles. It's a framework that sets out clear expectations for consumers, investors, and for downstream gold supply chain as to what constitutes responsible gold mining. Companies that are implementing the responsible gold mining principles will be required to obtain external assurance from a third party, independent assurance provider. This will provide further confidence to purchasers of gold that the gold they buy is responsibly mined and resourced. In a nutshell, the principles of responsible mining commit a company to an ethical conduct, an understanding of the impacts of its activities, using a supply chain that is also ethical and responsible, to protect and promote safety and health, to respect of human rights, to respect labor rights, to working with communities, to environmental stewardship, to conservation of biodiversity, to responsible land use and mine closure, and to reduce water, energy, and climate change threat to the locations where we work. In the same vein, the Mining Association of Canada in 2004 created the Towards Sustainable Mining Initiative to raise the bar for responsible mining and to facilitate continual improvement. They developed 8 protocols to assist management in energy management and use and greenhouse gases, in tailings, biodiversity conservation, water stewardship, indigenous and community relationships, crisis management and communication planning, safety and health, and preventing of child and forced labor, including by our suppliers. Adherence to protocols are self-assessed on a yearly basis by local mines and externally verified every 3 years, and the results are made public. So this is the Canadian the Mining Association of Canada, but these protocols were also adopted by mining associations around the world, including Argentina, Australia, Brazil, Botswana, Colombia, Finland, Norway, the Philippines, and Spain. So it is a widely recognized standard to improve ESG performance. In addition, the Canadian Mining Institute has recently issued the ESG guidelines to provide guidance for those using environmental, social, and governance information when preparing and implementing mineral exploration programs and contributing to the preparation of mineral resources and mineral reserve estimates for mineral properties that are either at the study stage or in operation. The ESG actions discussed in the CIM ESG guidelines follow a continuum that aligns with the project stages of a mineral project, from scoping through pre-feasibility economic assessment, preliminary economic assessment to pre-feasibility or feasibility studies. The guidance pertain to permitting, environmental and social management, and stakeholder engagement. So how are these ESG performance rated? There are a number of rating agencies, you can see a few of them here, that follow ESG performance of companies. These agencies rate the ESG performance of mining companies and provide these ratings to investors, sometimes free, sometimes for a fee. They form their opinion based on publicly available information, such as sustainability report, policies published on the website, or specific questionnaires filled by the company. With a view to evaluate risks for the shareholders, they also evaluate how controversial the company is based on media coverage. Any bad press stays on their files even 10 years after it happened. So how is ESG performance disclosed? The Global Reporting Initiative was originally used to disclose ESG indicators, and they had a number of indicators. More recently, the Sustainable Accounting Standards Board had issued a number of indicators on which companies have to report. With the increased importance of the risk associated with climate change, the Task Force on Climate-Related Financial Disclosure, TCFD, issued their own disclosure standards. So in order to reduce because of all of this, they needed 3 reporting frameworks in order to reduce the reporting burden of companies and eventually make it possible to audit performance. Then the International Sustainability Standard Board, ISSB, which is an independent private sector body that develops and approves international financial reporting standards, they have issued 2 standards, IFRS S1 and IFRS S2, which actually combine SASB and TCFD requirements. So in IFRS S1, it's the general requirement for disclosure of sustainability related financial information, and it sets the core content for a complete set of sustainability related financial disclosure to meet the needs of global capital markets. So they're asking for disclosure of material information about sustainability related risk and opportunities with the financial statements to meet investors' information needs. And it applies a TCFD architecture of governance, strategy, risk management, and metrics and targets for disclosure of information about sustainability related risk and opportunities. It requires industry-specific disclosure and can be used in conjunction with any accounting requirements such as GAAP. So that's IFRS 1. IFRS 2 is strictly climate-related disclosure. It sets out the requirement for a company to disclose information about its climate-related risk and opportunities. So what is disclosed? So the disclosure requirements are in fact a mixture of data such as, say, greenhouse gases emission, management approach such as what system are you using to assess your risk, and behavior such as ethical behavior in business and with your employees. So these disclosures are done on an annual basis, and more they are included with the annual report of the company. Thank you for your attention.
Hello, welcome to our next session. This is on energy strategy and carbon footprint. It complements quite well the earlier presentation by Louis Grondin on ESG, because really carbon management is a subset of the overall ESG strategy. Here are the topics that we'll be discussing today. I'll start out talking about energy usage within the gold mining sector, talk about GHG emissions, reduction targets that different companies have. How do we actually achieve the reductions that we're planning? Some of the challenges, and then I'll just wrap up with an overall summary of the presentation. So firstly, where is energy used within the gold sector? In the graphs that you see here, the two on the left, the first one shows for a typical open pit mine. The vast amount of the energy that is used is for diesel, for the mobile fleet. Then you have comminution, so this is the electricity for crushing and grinding and the SAG and the ball mills, and then other processing. So quite often this is typically pumps and other plant auxiliaries such as lighting. For the underground mine, you can see the quantity of energy is significantly lower, driven by the fact that the grade of ore is much better. So you have diesel fleet, then you have comminution. There may be other electrical underground loads, such as for mine ventilation, and then also the other processing as well. What we're also seeing nowadays is a lot of the underground mines, they are more electric. So the diesel portion that you see here for underground, that is starting to diminish as well. Energy is typically one of the top two operating costs for gold mining operations, so it definitely gets a lot of attention. The energy use that I've shown here, this is typical. It'll vary greatly depending on the grade of the ore to waste ratio, whether it's open pit or underground, the extent of electrification and the material handling technologies that are being used, and also the processing technology, whether it's heap leach or is it a mill. Here we compare the energy intensity of gold processing with other mines and other metals. Important to note, this excludes the smelting and refining that goes on a lot of the base metals. So this is strictly the mining and the main ore processing. So you can see for gold, open pit and underground, these are the numbers that we looked at before. 372,000, 134,000. This is gigajoules of energy per ton of product that's produced. By comparison, you can see for copper, open pit and underground, as well as for nickel, the numbers are much, much lower, obviously driven by the fact of the grade of the ore. Let's now just compare by different countries the energy intensity. So this is taken from a report from the World Gold Council. As you can see, the numbers vary quite significantly by country. The bars show the range for different operations within a country, and the diamond shows the average. Here you can see Canada and Chile are amongst the lowest in the world in terms of overall energy intensity in gold processing. This next graph here compares the grid electricity emissions factor for different countries. So you can see for South Africa, Australia, US and Nevada, and in Canada. Canada is significantly lower, largely driven by the fact that a lot of the electricity produced in Canada comes from hydroelectric or from nuclear, with obviously much lower GHG emissions, whereas in Africa, a lot more is in thermal, especially coal. The different categories of GHG emissions, you'll see these terms quite a bit in reporting of carbon emissions. There's Scope 1, Scope 2, and Scope 3. Scope 1 are the direct emissions from the sources, the mines. So this would typically be the fuels that's used for the mine hauling and on-site power generation, as well as for process uses. Scope 2 are the indirect emissions, so that's largely the electricity that's purchased, the emissions associated with the grid electricity. And thirdly is Scope 3, which are the other emissions, which are upstream activities, downstream activities related to transportation, use of the products that are made. In 2018, the total GHG emissions of the gold industry was estimated at about 126 million tons. Again, this is taken from a WGC report. You can see Scope 1 and Scope 2 are almost equal, part of that, and Scope 3 was smaller. However, a lot of the methodologies for estimating Scope 3 emissions are being refined, and these numbers for Scope 3 are likely higher than what have traditionally been reported historically. So what are the GHG reduction commitments and what are the companies actually doing? Most of the major gold mining companies have made commitments towards reducing GHG. They're both interim as well as for 2050. Most of them for 2050 plan to get to net zero. And for 2030 is quite often a common intermediate goal. Typically a 20 to 40% reduction is what we're seeing by several of the companies. Now, how are these emissions intensity reductions actually defined? It can either be in terms of absolute emissions, like Scope 1 and Scope 2, total tons. It could be on an emissions intensity basis, so that's looking at the kilograms of CO2 per ounce of gold that's produced. And some are even going further and including Scope 3 targets, because that is getting more and more attention from investors and others. So how do we actually get there? What are the different elements of the strategy to reduce GHG emissions? This just kind of lays out an overall framework. First of all, it's improving the energy intensity of mining and processing. So this is typically your continuous improvement projects, the energy efficiency projects. Also, when you're developing a new mine, to incorporate energy efficiency design right from day one. Second is improving the GHG intensity from electricity generation, whether that's either on-site generation or from the grid, having a lower GHG intensity for that. Thirdly is improving the GHG intensity for material movement. So for example, haul trucks, can those be, instead of diesel fuel, can they be battery electric vehicle or hydrogen? And then lastly, these are some of the market mechanisms using offsets or renewable energy certificates. These are some of the new market mechanisms just coming into play right now. So transitioning to clean electricity, what are some of the options? Some of these technologies have been around for quite some time. Others are under development. Wind, solar, hydroelectric, these are traditional renewable energy technologies. Last few years, they're seeing energy storage technologies become more common, and the cost for these are really starting to come down significantly. Alternative fuels such as renewables, renewable diesel, renewable natural gas, other biofuels, small modular reactors or micromodular reactors. So these are nuclear reactors, much, much smaller in size, designed for remote locations. These are just in the development and pilot scale demonstration phase right now. It'll be interesting to see over the next 10 years how this technology develops. And these are just a handful. There's several others as well. Here's an example of a project, a solar project. This is a project located at the Tasiast mine site for Kinross Gold in Mauritania in Africa. This system has 34 megawatts AC capacity along with an 18 megawatt battery with half-hour storage, so it gives you about 9 megawatt hours of storage. 88,000 panels in total at this facility. This facility, it's not connected to the national grid as it's an islanded grid system. So what the solar panel is able to do is offset the on-site generation that's using fuel oil for the production of power. Capital cost here was about 55 million. Payback economics, roughly 5 years. The CO2 reduction over the life of mine was about 530,000 tons is what's been estimated. And the GHG reductions will represent about 2% of the company's total GHG emissions. So as you can see, not only do you get significant reduction in GHG, but there's a strong business case for this project and this type of technology as well. That's where you're seeing it become quite common in several facilities. Now let's just talk about improving GHG intensity from material movement, talking about the mobile fleet. This diagram here just shows you kind of the spectrum of technologies and how things are being developed. So on the left side, you see business as usual. So that's your traditional diesel haul truck. Then as we move through, there's other technologies that are actually ready now that can be implemented. So for example, in underground mines, there's a lot of electric equipment that can already be implemented and used. For surface mining, electric shovels and drills, these are available and economic. And also where possible, maximizing the use of conveyors. Doing mining differently, especially for trucks. There's a lot of trolley systems which are available and have applications, and also a lot of the support equipment such as graders, fuel trucks, light vehicles. These are also starting to become available and to be economical. And then at the other extreme, we have technologies that are currently under development. So for surface haul trucks, we have hydrogen as a fuel, battery electric vehicles, hybrids, and other alternative fuels. I'd say these are coming into play right now, but they're not fully proven commercially and technically in a large scale yet. What are some of the many challenges in implementing carbon reduction strategies? First of all, there's uncertain and diverse government policies we see in different areas related to carbon taxes, emission standards, and others. It makes it very difficult for businesses to make decisions when they don't quite know what the regulatory framework is. Secondly, there's a lot of new technologies. There's always a risk with being an early adopter of the technology. You don't know what the reliability is going to be, what the technical support for the technology is going to be, what the economics will ultimately be. Battery electric vehicles, hydrogen are just some examples of this. Also, electrification requires some significant increases to the grid in terms of generation capacity, transmission capacity. So there's issues around who's actually going to pay for this, who's planning for this, how's cost to be shared, what's the timeline to implement all of these. So there's significant questions around these, and each region and jurisdiction is working its way through this. In summary then, mining companies have been taking steps to reduce their GHG emissions, actually for quite some significant period of time. Most major mining companies have made reduction commitments, both long-term for 2050, as well as for intermediate period of time. There are many technology options to get there, and there's others that we're seeing becoming available, but there are risks and challenges in getting to net zero. Thank you for your time.
Hi, everyone. We are going to be joined now by Lisa Davis, CEO of Petroleum Financial, also Louise Grandon, who is the former Vice President of Environmental and Sustainability at Agnico Eagle, and Sunil Kumar, who's Principal at NSky Consulting, and also formerly VP of Energy Strategy and Engineering at Kinross. And they'll be joining us shortly. So, and I would remind everyone that, I remind everyone that we do take questions. If you look at the bottom right of the screen, you can send in questions, as many people have been doing. Yes, we will start now. Lisa, let's start with you. How are you? Struggling to hear you. Might be on mute. Right. While you're doing that, Lisa, I'm going to go to Louise. Louise, how are you?
I'm good, thank you.
Good. ESG and risk mitigation, very sort of contentious subject for some. If you ask some of the old-time miners, to say we've always really done ESG.
Yeah.
And if you ask others, go, well, it's about time miners are held accountable. How has it evolved over the past few years?
Well, I think we miners, I believe that we do the right thing, but maybe we don't communicate it enough. And there is a lot of anti-mining sentiment right now, maybe in Canada, at least in some areas. And they don't understand what we're doing because we do it. We don't necessarily disclose it. And we don't necessarily disclose it in a manner for them to understand. Because you've seen like the alphabet soup of standards and everything, but I think there needs to be a little bit of a work done on to convey this information in a palatable fashion to all the stakeholders. So there is a lot of stakeholders, there is a lot of information, and there is a lot of platforms through which you can communicate it. So there is a lot. I mean, nowadays you need to communicate what you do in order to be allowed to continue doing it. Social license to operate. So.
Okay, fair point, good point. Lisa, have we got you back?
Can you hear me now?
Alrighty, right, Lisa, you've done some tough ones. Okay, you're talking about expanding the universe of exploration capital. That is what the sector needs: new money and lots of it. And if we can do as Louise says, communicate better, maybe we've got a chance. So just to kind of kick off, can the exchange in Canada, we'll take Canada, do more to help investors invest? Can they remove barriers to entry?
I don't know if it's so much about the exchange. I mean, one thing that sometimes is a little bit tricky here is the kinds of resale restrictions that we put on our shares, but I think there's pros and cons, especially for junior companies, as to whether they want to see those restrictions there or not. But there is definitely room for just better education about the way that people can fund exploration projects in Canada. I mean, I think a lot of non-Canadian institutions just aren't really aware that there's an opportunity for them to invest through a structured flow-through financing. And, just because there's so few choices for junior companies in terms of how they can access capital, and so much of the funds that can be raised are raised through flow-through offerings, given the incentives to Canadian retail investors. Either there's just a general lack of awareness about flow-through offerings like completely outside of Canada, or to the extent that there is some knowledge about them, there's not an understanding that there's a way to participate if you're outside of Canada, or if even if you're a Canadian institution or strategic investor, where you just wouldn't see that as an opportunity to participate. So I do think better education all around could improve things.
Right. Okay. And I'm just going to bring Sunil into the conversation, and then we'll kind of get into it. So Sunil, hello and welcome. Can you hear us?
Fantastic. Yes. Can you hear me? Can you hear me?
Yes, sir. Right. So great presentation, by the way. Some fantastic things in there. But he was kind of focusing around energy costs and some of the opportunities ahead of companies in terms of how they improve things, their efficiencies, etc. But it's also the side of the business which contributes towards this sort of negative sentiment towards mining companies is around the energy inefficiencies, and I guess the dirty component. Where's the energy come from? Is it from coal or fossil fuels? So are we trying to phase out fossil fuels in mining? Is it possible?
I think the answer to that is very site specific. And when we talk about phase out, over what period of time, in some places where there's other options available, it might happen quicker than in others. But in some other areas, your options may be limited in terms of what other fuels are available, renewable energy, and it might take time. I think one of the really interesting opportunities that's coming up is, if you look at the total emissions, not just the electricity side, but the fuel side, is traditionally open pit mines have used haul trucks using diesel. Some of the new things that you're seeing now is with battery electric vehicles coming in, not just for some of the mining operations for surface, but for the actual hauling. There are some limitations to that, some of the technologies coming in. But as that technology becomes accepted and is demonstrated, that takes off a whole bunch of GHG emissions, especially from open pit mines. So I think to answer your question, I think there is a transition. It's happening. It'll go at different speeds in different areas, depending on what's available. But it definitely is happening.
Right, and I'll stick with you, and then for now, if I may. Companies are looking to buying carbon credits as to offset their own situation. I say it's case by case basis. Some people, Canada may have hydroelectricity available. It's cheap, it's clean, it's great. Others don't have that option. Do you think that buying carbon credit is a good enough response to some of the accusations being made, or should they look to other ways of tidying up their own emissions?
Yeah, I think generally what we're seeing is a two-pronged approach. First of all, do as much as you can yourself. And then over the long term with a balance, then you can look to carbon credits. So if you go back to the pictorial that I showed of the different strategies, getting the carbon credits or RECs was kind of the last little bit. The other thing is, in terms of carbon credits, the market for that really is not very well evolved and robust. There are some regions that have well-defined structures for what's a carbon credit, but is there an international, truly fungible carbon credit, REC? It's not there today. So you think you're getting carbon credits, but what is it worth? Is it viable in the jurisdiction that you need to offset? I'd really be cautious about that. So I think it is happening very slowly, but that should not be the primary source of reducing your GHG emissions.
Right. Okay. And so it's not a case of we planted some trees, it'll be okay, or we bought some carbon credits. It's a case of if the fairly nascent sector industry, as to say, once it evolves, I guess we will get a sense of how companies are going to react. Louise, back to you. With regards to what ESG reporting has done, I mean, it really took off over the kind of COVID period. Big funds getting behind it, and now it's practically impossible for fossil fuel companies to get in any kind of investment into them without the relevant reporting. Has it made the mining sector? Has it made, and I'll expand it to the oil and gas sector? Has it made these industries any better? You said it earlier that we've always really done it and not been very good at communicating, but what's the actual new reporting done for us?
Well, I think it first of all, transparency probably breeds a better structure, a better internal structure, and you have frameworks that are imposed on your operations. But these frameworks make sense. They look at how do you manage not only the emissions, but how do you manage your risk? How do you assess your risk, first of all, and how do you manage your risk? So in the end, like frameworks like TSM, that's how they do it. They ask you, okay, do you have policies? Do you have who's responsible? Do you have an org chart for these areas of responsibility? And I would say that the ESG performance of a company is a surrogate for, is it a good manager? Are you managing well? If you're managing well your health and safety and your environment and your people, you're probably also managing well your cost and your production. So it's all part of being a good company and a well-run company. So if you treat that as something outside of your operation, that's something that you need to do at the end just to report, of course it's not bringing any benefit. But if you implement all these reporting structure and in fact management structure within your own management, then that's going to improve your whole business, and you will avoid paying things like the higher risk will be identified, managed, all the risks, not only the ESG risks. So I believe that it improved your performance if it's well done.
Yeah, and I think the risk, when you were talking in your presentation, the risk mitigation component made a lot of sense to me as an investor, but I can understand why other kind of key stakeholders would be focused on the environmental and the social component as well. Now, that's all well and good for big companies with big balance sheets, with capital. What do you think? Do you think there should be a slightly different way of looking at things when you're talking about some of the juniors? Should they have to bear the cost that they do, because that money is important to them at that phase of their development. The time delays associated with those reports is important to them. Do you think there should be sort of some sort of bifurcation in terms of the way that the ESG component is measured and monitored?
Well, probably, but the juniors, they will be looking for investment, and they will be looking for being bought at one point by bigger companies. And if you don't start to begin with your engagement with your communities and taking care of your business as a good operator, as a good exploration company, you're at risk of not getting the funds or not being able to sell your property once you have an ore body that's valuable to a bigger company, because the company in their due diligence, they will look at that as well. I agree with you. The reporting should be adapted. There might be a place for a platform to allow communication of junior companies' ESG data in an easier way. They don't have to have the whole department, for example. They could go to a platform that would be really useful, I believe.
Okay. And Lisa, I'm going to come back to you, if I may. You talked about flow through. You briefly mentioned flow through earlier on, but very specifically, the recently enacted and proposed legislative changes, when we're talking specifically around the new critical minerals exploration tax credits, I think that green companies specifically are leaning into. What's your outlook, though, for flow through financing of gold exploration specifically?
Well, it's interesting. I mean, we've seen quite a dramatic change over the past couple of years. I think it was in the April 2022 Canadian federal government budget that the critical minerals exploration tax credit was introduced. And I would say until that time, just generally, we were seeing that most of the funds that we were putting into exploration companies were for precious metals, primarily gold. And when I say most, I mean, 90%, like a very, very high proportion. When the critical minerals credit was introduced, that there was a very sudden change, and the money started being driven towards a number of critical minerals. I mean, lithium and uranium probably were at the top of that list, but it's hard to say, how much of those funds were sort of diverted from gold as opposed to, new interest, both because of the exploration tax credit, but also because of other, factors that are relevant in investing in those critical minerals. So that's one thing that's, I think, a bit of concern for gold exploration in particular. However, the other big change, which is still not sort of solidified as far as exactly where the Canadian government is going, are proposed changes to alternative minimum tax. And most of the people that we deal with, although they're acquiring their shares for donation purposes, so the impact of these proposed changes are actually magnified. But whether you're buying flow-through shares for donation purposes or investment purposes or just tax shelter, the greater the size of the tax benefits, the more significant the negative impact will be from these proposed changes. So there's a bit of a sort of a good news, bad news story there for gold, because gold exploration isn't eligible for the 30% credit, only the 15% credit. And that's, driving people potentially into other, types of exploration. But on the other hand, this limitation will basically mean that in order to invest in flow-through shares for critical minerals, you need a higher amount of income as an investor than you do to invest in gold. So I think there's a lot, we're going to see a lot of like quite a dynamic market in the first quarter of the year. I also think that the premiums that are commanded in flow-through share offerings are pretty likely to go down if the alternative minimum tax changes are put into place as proposed, because it's this limitation is based on sort of the dollar value of what you buy, and so I think just supply and demand is likely going to push premiums down.
Okay, it kind of you're describing something that is well, seems to me as a retail investor seemingly complex, and it may make my life a little bit more difficult. So, with situations such as, say, an acquisition or doing an IPO, when companies are raising capital, how do you look at that?
Well, I mean, I'm not sure that that's really kind of tied to the same issues that we've been discussing. I mean, the nice thing about doing these structured flow-through transactions is that they're very flexible. So regardless of whether we see, premiums coming down a little bit, I think I think there's a lot of opportunities. And again, it's education. It's kind of working with people who know how to structure these transactions early on, because whether it's an IPO or whether, for instance, there's a subscription receipt offering because the company's looking at acquiring a new exploration property, and then they want to raise money using flow-through dollars because they're going to be spending on the new property. There's a lot of flexibility in structuring these arrangements. It's not just kind of what you were seeing a decade or more ago when it was traditional retail flow through limited partnerships that were the investors. It's a small niche industry, and there's a lot of niche expertise and maneuverability because we're sort of small companies, and this is primarily what we do. So I these changes I don't think are going to impact that. It's more going to be an impact on kind of pricing and whether we're going to see a little bit of a continuation of capital seemingly, if it's traditional flow through investors that are really looking for tax shelter, they're going to be driven to where the highest tax benefits are. So that's a bit of a concern for gold.
Okay, and I know we're meant to be talking about gold today, and I don't mean to conflate here, Sunil, but you talked about hydrogen on the trucking side of things. What about SMRs in terms of your small modular reactors? I'm talking nuclear reactors for some of these larger projects. Is that something that may be possible down the line?
There's definitely a lot of interest in that. You're seeing a lot of companies popping up with projects. In Ontario, there's 2 projects being planned for later in the decade. I think also we just need to be clear on the terminology. Sometimes they call 300, 400 megawatt reactors as small because it's small relative to what's there right now. I think for the mining sector, for remote locations, things which are less than 100 megawatts is what's more apt and more viable. So a number of companies offering this technology. How the permitting is going to be streamlined. Getting a mine permitted is hard enough. You layer on the top trying to get a nuclear plant permitted. That's an additional challenge. And what's the technology? What's the cost? So I think let some of these projects happen by the end of the decade. A lot of mining companies are following it, and then we'll see what happens. I'd also see the business model, maybe you contract with the technology provider, and he basically sells you the electrons over the fence. They take on all the permitting, the capital costs, the operating risk, and the benefits are shared. That's probably a model that we might see for the first few units. So okay. Yes, stay tuned.
That could be exciting. With most questions sent in about ESG, so it's quite contentious. People sitting at either sides of the fence here. So, but Louise, if I may finish with you, Canada specific. Companies that are developing mining projects must consult with Indigenous peoples. What are those conversations like? What are the kind of key drivers around those conversations? It's a very emotional, emotive discussion, I'm sure, and a financial one at the same time. So How does a big company manage that relationship and those conversations?
Well, I think you have to start it from the point of view of a partnership. And I mean, you have to understand what's in it for them. If your project doesn't bring anything at all to the local community, why would they agree and support it? So if you have to start to understand where they're coming from, and that doesn't start, like, you don't get there the day before you need a permit. These relationships take years, and you need to understand the specificity of the First Nations you're dealing with, and their needs. And I was talking in my presentation about the expectation that mining companies are now contributing to infrastructure and housing, and is real. In places where we mine, the government is not there, and we have to contribute to bettering the community, whether it's a First Nations community or otherwise. And Sunil, you were talking about energy. You know, there is a big portion of Canada, the First Nations, they get their electricity from diesel generators. If mining companies can partner, for example, with those communities to push this agenda of green energy in these areas, we will contribute to bettering society. And this, I know we're a business, but I mean the expectation of society now is a lot more than just make money and go home. Companies are expected to contribute to resolving some of the issues, whether it's housing, whether it's energy, whether it's education, even training, providing good jobs, providing a future for these kids. So First Nations, I would say at the end of the day, if we're there for them, they will be there for us.
Fantastic. Well, look, I'm going to wrap it up there. I want to say thank you very much to Lisa Davis, CEO of Pear Tree Financial, and Louise Grandon as well for your insight into ESG and the importance of it, and Sunil Kumar, principal at N-Sky Consulting. By the way, great presentation. We are going to wrap it up, and Boyd's going to come in and just summarize things as well. But I want to say for people listening today, and look out for tomorrow. It's a sort of action-packed day. We are going to talk about gold extraction and processing, exploration, mining methods, ore types, removal, recovery, it's and beyond, tailings, effluent treatment, etc. It's a really action-packed day, so look out for that one. And thank you very much for joining us today, everyone.
Thank you.
Thank you.
Well, thank you very much, everybody. Actually, Matthew, you stole my thunder, because I was actually, I wanted to specifically thank all our speakers today. We had a great discussion, wide range of topics about how to invest in gold, some of the considerations, some of the options, and some of the pitfalls as well. And tomorrow we talk about winners and losers, and have a detailed discussion on, as Matthew said, on some of the technical aspects of it, geology, mining, processing, tailings, and effluent management, as well as recycling. So thank you very much for joining today. And I also really wanted to thank the World Gold Council and CI Financial Private Wealth Management for sponsoring today and tomorrow. And we'll see you tomorrow. Thank you very much. Goodbye.